Welcome to the risk analysis homework. Today we're going to be looking at is doing some simple risk analysis, and we're going to be again using H&M as our example. Now in front of you, you see the risk analysis worksheet that is uploaded onto iLearn, and you can see that there's a few different models that we're going to be estimating here. So the first one we're going to be estimating is the credit analysis, and specifically the bankruptcy prediction, that is also referred to as the Altman Z-score. And we're going to be estimating two different kinds. So one of them is for manufacturing firms, which is the original model, and one that is for non-manufacturing firms. So this kind of captures the firm's probability of default and its risk of going bankrupt. And down below, we're going to be calculating a slightly different type of risk, which is to do with accounting manipulation. And this is the Beneish M-score. And the Beneish M-score effectively looks at a number of different kind of red flag items and combines them into one single model. And again, it gives you an M-score and a probability of kind of manipulation in this case. Again, both models are slightly complex. Probably the Altman one is more simple than the Beneish. We're going to go through it step by step. Now, in addition to the models that we're going to be calculating, I'm also going to show you how you would identify disclosed risk. So when you do credit analysis and estimating bankruptcy risk, or when you might be looking for accounting manipulation and estimating the probability of accounting manipulation, you're effectively trying to estimate undisclosed risk. But a lot of the times there is a lot of risk that is disclosed by the company itself. So in the annual report, if you report according to IFRS, and again, I'm just going to find the 2016 annual report for H&M here. In the annual report, similarly as what we did for accounting analysis, for risk analysis, most companies will have their significant risks disclosed. So in this case, this is the 2016 H&M annual report, and say I want to find the risks that H&M is exposed to. And again, the whole idea why we're doing risk analysis is really that we want to understand the risks associated with the future returns, and essentially trying to help us in our forecasts, but also then in our cost of capital. So again, we start out with the annual report, and again, if I want to find out the section where I can find some stuff about risks, I just search for risks within the report, and I see I have, let's see, risk has 110, 111 hits. So I'm just going to press enter until I go down. I guess I'm just going to zoom in a bit so you guys can see a bit better. And I basically just go down and search for a risk and see what I can find until I find something that I know is talking about something. So generally speaking, it will be probably about note 1 or 2 of the annual report, but again, usually you'll see that they talk about risks throughout the annual report. Now, the part that I'm actually interested in, and because here I can definitely start to see specifically down here, they start to talk about page number. For a description of H&M's operational risks, see the administration report of pages 73 to 74. And for risks within financial reporting, see administration report 74 to 75. And then note 2 financial risks on pages 89 to 90. So basically all these pages contain information about the risk exposure of H&M, and again they divide it into operational and financial. So if we look at the operational just as an example, 73 to 74, I'm just going to scroll down to page 73, see if I can find it. 70, let's see, where are we now? It's loading a bit slowly, unfortunately. I'm not sure why. 72 and then 73. So here we see a section called the risks and uncertainties, and effectively it just talks about all the various uncertainties that are that are facing H&M, and these are quite important to understand when you're forecasting, for example, the sales or expenses of the company, because you know how certain you are of this kind of prediction. So for example, if you know that there's a lot of risk exposure, you might also have an alternative scenario that is slightly less optimistic. So for example, under operational risks, they have things like reputational risks, in the sense that they might lose some reputational capital. And we do know, if you've kind of been following the news, that H&M was involved in some kind of problems with its reputation just a few weeks ago with an ad, I think in South Africa, If we go down, we have things like fashion risk, and again, this is something that is very specific to retailing, and that is basically just predicting trends poorly, so you can't sell your stock. We have things like weather risk and negative macroeconomic changes and geopolitical risks and so on. So the idea is that you will go through the annual report for your own company and look through all the various risks. And the idea is that you will more or less summarize each potential risk that this company is facing, but the final product that we usually see within an evaluation or within an analyst report is something similar to this. Again, it's going to take a while to load, but it's basically something that's called a risk matrix. So in this case, this is a risk matrix for Copa Airlines, and this is actually a student project that was done for the CFA Analyst Challenge. So you can see that the risk matrix basically looks like this, where you have one kind of axis that is probability, so is it a low, medium, or high probability of occurring, and then the impact on the company, so is it low, medium, or high. And then essentially you have the individual risks within here. So for example, there's a high impact if there's a higher jet fuel prices, but the probability of this is medium. And what's nice about this is that they've also color-coded each individual risk according to it being a market risk, operational, or a financial risk. So again, the idea of doing a risk analysis and a risk matrix like this is because it gives you a very quick overview of the risk exposure. So if you know, for example, the probability and the impact of all the risks are in the low quadrant, well, then you know that the future returns are somewhat safe. So this is going to impact my forecasting, and it's also going to impact how I estimate beta and so on. Because again, when you come to the week when we talk about cost of capital, you'll see that the calculating beta, quantitatively speaking, is not always very precise, which means that you actually need to think about the underlying risks in a qualitative manner in order to do it correctly. So again, this is something that you'll probably be doing in the Thursday session. So on to the undisclosed risks. So let's see if we go to the homework topic 4 worksheet. So again, the undisclosed risks are effectively the risks that are not going to be disclosed by H&M. So they're not going to say that they're facing bankruptcy and they have a 50% of going bankrupt. Again, the reason why we even care about bankruptcy is because when somebody, I guess, buys another company, generally speaking, you don't buy well-performing companies. You generally buy poorly performing companies that you think you can turn around, which means that most of the companies you're going to be purchasing in acquisitions will have some form of default risk. So again, for this purpose, we're going to be using the Altman model. And again, the Altman model was developed in 1968, so it's super old, but it's still widely used today because it's very, very simple. So here in, I guess, row 14, you can see the actual equation that the Altman model uses. And again, this is something that we cover in the class. So you can see that it's calculating a z-score, and that's equal to 1.2, so a number, so the coefficient, multiplied by variable x1. And here we can see below x1 is current assets minus current liabilities divided by total assets. So essentially your working capital divided by total assets. Then you add the second part, which is 1.4, and again the coefficient multiplied by x2, and then x2 is retained earnings divided by total assets, and so on. So the idea is that you're estimating an equation, and that's going to give you a prediction score, and that prediction score is going to tell you whether the firm is in the safe zone, the stress zone, or the gray zone where we don't necessarily know exactly what's happening. We're also then going to be using the norm dist function in Excel to estimate the actual probability of default in percentage terms. Again, this model is from '68. It was considered very accurate back then, still widely used, but there are better models out there. However, this is super simple. It has 5 variables in total. If you're going to be looking at more complicated models, they might be modeling non-linear effects. They might have 20, 30 different variables and so on. So this one is quite nice to just to get a grasp of how credit analysis works. So how you would estimate this is essentially you would calculate each ratio for each year, and then to get the total z-score, you would multiply each coefficient by the value for that particular year, and that gives you your z-score. And then the prediction works by looking at the cutoffs, which are specified by Altman, and then using those cutoffs to say whether the company is in the safe, distress, or the gray zone. So let's start by calculating the first variable. So it's current assets minus current liabilities divided by total assets. So it's equal to, open up a bracket, current assets minus current liabilities, and then we're going to be dividing it by total assets. Again, current assets divided by current liabilities divided by total assets, and it's going to be about 0.39. So x2 is retained earnings divided by total assets. So retained earnings is in cell D9 and divided by total assets in cell D6. Earnings before interest and taxes divided by total assets is the next one. So EBIT is in cell D4 and divided by total assets, and again cell D6. We then have market value of equity divided by total liabilities, and market value of equity, and we divide it by total liabilities. And then finally we have sales divided by total assets. And in this case, let's see, sales, again, sales exactly the same thing as revenue, and divided by total assets. Press enter and it's 2.01. So this gives you the values for each individual variable for that particular year. And again, once we've calculated for 1 year, we can drag it to the right and get it to be calculated for the remaining years. And then the total Z-score is merely equal to each coefficient multiplied by that value. So you can either take equal to and then take the coefficient, multiply it by 0.39, then plus 1.4, multiply it by 0.76, and so forth. Or you can use something in Excel that's called the sum product function. So the sum product function allows you to multiply two arrays very, very quickly by highlighting the first column that you want to multiply against the second column. And again, close the bracket, and because we're going to be dragging it to the right, we want to make sure that the coefficient column is locked, which means that the C15 to C19 part of this formula, what you want to do is you want to press F4 when you're, in that area in order to lock those cells. So you essentially add the dollar signs around the cell references. What that helps you to do is essentially when you drag this to the right, it then locks the coefficient column for you while still allowing you to use the relative value column. So again, we can see that the total Z-score is quite high, and because the cutoff is 2.99, this is way above the cutoff. And again, H&M is not necessarily a takeover target, and it's going to have a very low probability of default because it's quite a safe company. So down below we have the Altman Z-score that is modified, and again the only difference for the modified model is really that we're dropping one of the variables, which is sales divided by total assets, and the reason is the modified model is made for non-manufacturing firms, and the sales total assets is a variable that is very important for manufacturing firms but not so much for non-manufacturing firms, and that's the reason why it's dropped. And because it's being dropped, the coefficients were re-estimated, so they're slightly different. But again, the actual values for those variables is exactly the same. So I've just referenced what we've calculated above, and that's it. And again, if we use the modified model, the total Z-score is still very, very high, and we're still very much in the safe zone. Again, for some of you, some of your companies will probably not be in the safe zone. And what you need to do then is to figure out which variable is driving this prediction and why is that variable kind of weird in one way or the other. So that's kind of the credit analysis section. The next section is the Beneish M-score, which is somewhat complicated, not from the fact of the model, but because the calculation of each variable is somewhat complex. So the Beneish M-score essentially tries to estimate your probability of accounting manipulation by looking at a number of different red flag kind of items. And what it looks at specifically is index items. So essentially it compares the days receivable, for example, for this year to the one last year, or it compares the gross margin last year to this year, and so forth. And it basically looks at the trend over time. So if it sees a positive or a negative trend for one of the items, that means something in terms of, it adding to the probability of there being something, wrong happening from an accounting perspective. Now again, here on the right, you can see the kind of hints for each row, in a sense that each variable is somewhat complex to calculate because there's several items and you might need to use several brackets at the same time. Another important thing is when you see the little subscript T, it means that it's this year. So accounts receivable, notes receivable T means accounts and notes receivable this year. But when it says T-1, it means accounts and notes receivable in the last year, and that's essentially it. And you kind of go through and you calculate each and every one. And again, at the end, you do the same exercise. In a sense, you calculate a total M-score in this case by multiplying the coefficients by the values. But in this case, you also add an intercept. And that is effectively kind of the part that you need to be doing now. So again, to calculate the days receivables index, and again, just be careful because it's super easy to make a mistake in this case. So again, I'm going to press enter, and then open up a bracket. So equals, open up a bracket, and I'm going to take accounts and notes receivables in this year. So again, accounts and notes receivables in this year, and divided by revenue in this year. Close the bracket, divided by, open up bracket, accounts and notes receivables last year, divided by revenue last year. Close the bracket, and we get the score 0.86. So again, 0.86 is what you want to see. If you didn't get that number, you might have made a mistake, so just go over your formula. So for the gross margin index, on the other hand, we're looking at, again, equal, open up bracket, but in this case, we take gross profit in last year compared to revenue last year. So gross profit last year divided by revenue last year. Close the bracket, and we're going to divide it by gross profit in this year. So again, open up a bracket and compare it to revenue this year. Close the bracket, press enter, and it should say 1.01. For the asset quality index, again, this is a somewhat of a complex formula. It's a bit long, but essentially what you see here is the formula here to the right. I might actually need to make the screen slightly smaller, or the text slightly smaller, so you can see the entire formula. And again, this is somewhat complex because there's a lot of different brackets here. So this one you have to be really careful with. So in this case, we're going to use equals, open up a bracket, 1 minus, open up a bracket, current assets in this year. So again, look for current assets in this year. So in row 45, plus property, plant, and equipment. Let's see, property, plant, and equipment is the next line, plus long-term investments. Close the bracket, divided by total assets in this year. So let's see, total assets in this year. Close the bracket, and then divide that by, open up bracket, 1 minus, open up bracket, and again, similar to what we did for the first part, you're doing it for the past year. So in a sense, current assets for the last year, plus property, plant, and equipment, plus long-term investments, close the bracket, divided by total assets last year. And then I think we still need to close that bracket. Press enter, and it should say 1.4. So again, if you don't get that number, you probably made some silly little mistake somewhere, to just go and check. So for the sales growth index, it's merely the revenue this year compared to the revenue last year. So it's quite an easy one. Enter. For the depreciation index, again, you just follow the kind of the hints here on the right hand side. So you take equal to, you open up a bracket, depreciation last year. So let's see, depreciation expense last year. Then we divide it by, open up a bracket, depreciation last year plus PP&E net. So then close the bracket again, and then take divided by, open up a bracket, depreciation depreciation this year, divided by, open up a bracket, depreciation plus PP&E this year, and then 2 brackets at the end, press enter, and should be 0.97. Now for the SG&A expense, again, a long formula here. In a sense, we see here on the right that it's somewhat long, but again, just try to follow it a bit slowly. So again, equals to, open up a bracket, SG&A expenses for this year. So again, you look for SG&A, sales, selling, general, and admin, divided by revenue this year. Close the bracket, divided by the same formula but for the previous year. So again, SG&A divided by revenue, close the bracket, press enter, and it should be 0.99. Now the leverage index, again, equal to two brackets at the beginning, current liabilities in this case. So again, I'm going to look for current liabilities in this year. So in row 51, plus long-term debt. In this case, H&M doesn't have any. Close the bracket, divided by total assets, close the bracket, and then divided by the same thing that what we're doing but for last year's. Again, two brackets, then we take the current liabilities plus long-term debt, close the bracket, divided by total assets last year, and again, close the bracket, press enter, and it should be 0.95. Then for the total accruals to total assets, again, it's essentially the income from continuing operations minus the cash from operating activities divided by total assets. So again, equal to, open up bracket, income from continuing operations. So that's in cell, let's see, D42. We then want to subtract the cash from operating activities, which is in cell D53, and then close the bracket, divided by total assets this year, and it should be negative 0.03. So that is essentially all the calculations. Again, it's complex. I know it's not easy, and you probably made a few mistakes, but once you're done, you essentially just drag it to the right. And what you need to do then is basically look at the total M-score. In this case, the total M-score is equal to, again, the coefficients multiplied by all the variables plus the intercept at the beginning. So again, C65 is the intercept, and then we have the coefficient column multiplied by the variable column. So it's essentially an equation estimation here. So we get a prediction of the M-score of negative 2.5, and this, according to the cutoffs, is low risk. And again, we're using the norm dist function, and we estimate the probability of manipulation, in this case, about 1%. So again, fairly low. Again, once you've done, make sure that you answer the questions on the bottom, which are the theory questions. And once you're done with that, just upload the finished product onto iLearn.